Hello everyone, welcome back to my channel. So, have you ever tried day trading just to have your broker hit you with a pattern day trading rule? Yeah, that rule is a trap for people who have smaller accounts. But listen, I'm about to show you exactly how to avoid it so that you can keep trading freely. If you don't have $25,000 in your account, absolutely no problem at all. By the end of this video, you will know what the pattern day trading rule is, how to avoid getting flagged as a pattern day trader, and you also learn 2 proven ways to trade without restrictions. So, make sure you watch to the end because I'm also going to be breaking down the biggest mistakes that traders make that get them stuck in these stock market streets. So let's get it. All right, so let's start with the basics. So PDT stands for Pattern Day Trader. This rule is set by the Financial Industry Regulatory Authority, which is also called FINRA, and applies to traders in the United States who use margin accounts. So what does this rule actually say? If you make 4 or more day trades within 5 business days and your account balance is under $25,000, then congratulations, you've officially been labeled a pattern day trader. So now you might be thinking, okay, so what happens next? So let's make sure we understand this. Consequences of the pattern day trading rule are as follows. So if you're flagged as a pattern day trader and don't have at least $25,000 in your account, your broker is going to restrict your account. So this means you won't be able to place any new trades unless you bring your balance above that threshold. So I know that this can be frustrating, especially if you're actively trading on these stock market streets, but you don't have the capital to maintain the 25K account. All right. I understand. It can be a little frustrating out here. All right. But I don't want you to worry about this. Okay. So I've got you covered. So let's go over 2 strategies to work around this rule so that you can keep trading freely. The first strategy is using a cash account. All right. So one of the easiest ways to avoid the pattern day trading rule is by trading a cash account instead of a margin account. So here's how it works. With a cash account, you're trading only with the money that you have. You're actually not using your broker's money in this instance. No borrow from the broker. And so let's make sure we though understand the catch here. You have to wait for your funds to settle before you can trade again. Okay, so there is a bit of a waiting period. And that waiting period is typically 2 business days. So if you make a trade today, then the cash from that trade won't be available until it settles. This is going to limit your ability to make multiple trades in a day, but it completely avoids being flagged with that PDT rule. So this is a really great strategy for beginners who want to day trade but don't have $25,000 in their account. And I'm going to say in their account yet, okay? Because we're going to get there, all right? The second option is to split your capital across multiple margin accounts. Now, if you prefer to use margin but still want to avoid pattern day trader rules, then another workaround is to split your account across several brokerage accounts, all right? So let's say you have $10,000 and instead of putting all of it into one margin account, you can divide it between 2 or 3 brokers. This way, you're spreading out your trades and reducing the risk of making 4 day trades in a 5-day period. So, of course, this is going to require some things, all right? First and foremost, it's going to require you to manage multiple accounts. And not all brokers are going to have the same fees or trading platforms. So do your research before going this route. So now that you know how to avoid pattern day trading rules, let's talk about some mistakes that traders can make that can trigger it, or even worse, to damage their accounts. So first and foremost, this is a common one, all right? Over trading. Just because you can trade doesn't mean you should. Listen, there's some non-negotiables out here, right? So trading too much, especially without a clear plan, can lead to unnecessary losses. And ignoring that pattern day trading rule is another big issue. So some traders think that they can sneak in an extra trade here and there, all right? But don't risk it. Listen, okay? Because your broker's keeping count, right? Your broker's going to catch it, and they're going to restrict your account if you go over that threshold. Also, another big mistake is not keeping track of your trades. It's easy to lose count of how many day trades you made. So keep a journal, okay? Or use your broker's tools to track your trades so that you don't accidentally break this rule. Another mistake that traders make is using all of the cash that they have available. Listen, do not do that, all right? So remember, cash accounts have settlement times. If you use all of your cash in one day, you won't be able to trade again until your funds settle. Another mistake is ignoring broker-specific rules. So different brokers are going to have different policies. Some of them may flag you faster, while others may offer you the opportunity to reset your pattern day trading rules or status, while others may help you to reset your pattern day trader status. Always make sure you understand your broker-specific rules. So now that you know exactly what PDT is, and how it's triggered and the consequences of breaking them, it is important to make sure that you follow these steps. So more importantly, you've got 2 solid strategies to keep trading without restrictions. If you found this video helpful, be sure to hit that like button and be sure to subscribe for more trading tips. Also, drop a comment below. Have you ever had your account restricted due to PDT? How'd you deal with it? All right, I want to know. So thank you so much for watching. I look forward to seeing you in the next video. Happy day trading.